What's up guys, it's Rishi from Prillo, and in this video I'm going to be doing a video for accounting application series with the instructional area of financial analysis. And again, all these videos are being made to help you guys go to ICDC this year. On this side, you can see the scenario that was used for this role play, and then on this side, you can see the notes that I used to conduct this presentation. Let's get into the role play. Good afternoon, John. Thank you so much for meeting with me today. As the new accountant for Dean Company, I've taken the time to analyze our inventory records and also calculate the cost of goods sold using different methods such as FIFO and LIFO. Now, I will also be talking about the different inventory valuation methods, ethical considerations for accounting practices, and how we can optimize financial performance and maintain compliance with accounting standards by reevaluating our approach for inventory management. Now, the first thing that I want to talk about is explaining our different methods that we use for valuing inventory. Now, inventory valuation is extremely important for financial reporting because it directly impacts the net income, the tax liabilities, and also the overall financial health that is shown on the paper and in the books for a company. Now, the three most commonly accepted methods of inventory costing include FIFO, LIFO, and the average cost method. So FIFO stands for first in, first out, and that represents the fact that the idea that the oldest inventory is sold first. And this kind of aligns naturally with the flow of inventory, and it normally results in higher ending inventory shares when the price is rising. Now, it also gives a more favorable balance sheet for the company at hand. Now, the second method is LIFO, and this stands for last in, first out. Now, this assumes that the newest inventory is sold first. And one of the benefits for this method is that it reduces taxable income in periods of rising costs, but results in lower reported net income and less favorable financial statement appearance as the trade-off for using this method. And now the third method that I want to talk about is the average cost method. And essentially what this does is calculates the inventory value based on the weighted average cost for all the units that are available for sale for Dean Company. Now, what it does is it just smooths out all the fluctuations in the unit cost, and it provides a very middle ground approach for calculating the cost of goods sold. Now, the second thing that I want to do is determine the cost and value of inventory. So if you take a look at this little sheet over here, you can see that the valuation of inventory is directly impacted by the financial statements, and it affects both the assets and the profitability of a company, as I had mentioned previously. Now, using those periodic inventory systems, I calculated the ending inventory values using both FIFO and LIFO. So here we can see that ending inventory shows that there are 180 units left, and using the latest purchases, so we would be multiplying 180 by $7, which is the latest purchase price. We would get a dollar amount of 1,260, which is the FIFO ending inventory. Now for LIFO, I'll also run you through that. We have 180 at the ending inventory, but then we use the oldest purchases as the price. So we would have $5 as that price, and then we would have $900 as our LIFO ending inventory. The ending inventory is higher for FIFO because we're using the latest, most expensive purchases that remain in inventory, while LIFO uses older purchases, and it assigns these higher costs to the cost of goods sold. And selecting the inventory valuation method should align with the company's financial strategy for that period. So now the next thing that I want to do is also calculate the cost of goods sold, right? So cost of goods sold, or COGS, is a very key financial metric that is widespread across the financial realm. And here's I'm just going to show you guys like a real quick like calculation process for the October month under both FIFO and LIFO. So for FIFO, we start with the beginning inventory of 200 units and we multiply that by $5, which is $1,000 for just beginning inventory starting on October 1st. Then there were purchases. We take October 1st with 300 units and then we multiply by that unit price of $6 and you get 1,800. Then you take on October 23rd the calculation of 500 units by the, again, latest price for the most expensive batch, which is $7, and then that results in 3,500. So when you add those values together, you see that the total available for sale is $6,300 or $6,300. And then the ending inventory for FIFO, we'll see that there's 180 units left over for the most recent purchase, and then we're taking that most expensive in a most recent price for the newer inventory, and so that's taking $7 multiplied by that 180, and then we get 1,260. So then when you do 6,300 minus 1,260, you get 5,040 as the cost of goods sold. Then now if we move on to LIFO, we'll see that the beginning inventory on October 1st once again starts 200 units multiplied by that $5, you get 1,000. Then if you take into consideration the purchases, the calculations are pretty much the same for FIFO and LIFO for the purchases section, where you'll see on October 12th, 300 units by that $6 unit cost, resulting in 1,800. And then October 23rd, you'll see 500 times $7, and that results in 3,500. When you add that all together, you'll see that the total available for sales is 6,300. So that's kind of the same for FIFO and LIFO, but then the ending inventory is again, is where the LIFO calculation comes into play, and then you multiply that 180 by $5, which is the price from the oldest inventory, resulting in a $900 deduction from the 6,300 for COGS, and that comes out to 5,400, which is greater than the 5,040 from the FIFO calculations. So LIFO actually results in the higher cost of goods sold due to the inclusion of more recent higher cost purchases in the expenses. So it turns into reduced taxable income. Now FIFO reports a lower cost of goods sold, leading into higher taxable income, but a stronger looking balance sheet. Now the third thing that I want to do is explain the reasons for ethical dilemmas. Now it may seem like really beneficiary to be changing the inventory costing method like annually, so then you're able to maximize your cost year over year. And some people even want to do it quarter over quarter. But why can you not do that? This is an ethical violation. The GAAP standards and IFRS guidelines require that there's consistency in the accounting methods, so then there's comparability in the financial statements when you're looking at something like a 10K, where over year you can see that there are different methods of there's like a method of calculation for a specific section that's lined up. So when it's not matching due to the accounting methods changing, that's where there's a problem created. Investors could be misled. Creditors and stakeholders would also be very misled. And this just creates a whole realm of different financial problems. So some key ethical principles that we need to consider there are three, and these are consistency, transparency, and fair representation. And so these three are extremely, extremely important, and it makes you come off as more reliable. It makes your company come out as more reliable if you're able to follow these three standards. And it's also something that a company must adhere to as an ethical, accounting practice. And this is just so then they avoid any regulatory charges coming at the company. Now, the last thing that I want to do is just answer some questions that you might have. So why is it important to maintain inventory records, right? So accurate records make sure that we have correct financial reporting, and we're also able to, protect ourselves from any fraud. And now, what can cause like inventory numbers besides purchases and sales to change. And so, there can be like shrinkage from, leakages and also theft, damage, and then like, if it's like a food product, for example, you can even have spoilage come into play. And then, there are also things that you can take into consideration, like let's say you have like an oil shipping company, for example, there might be supply chain issues. So that's something that can also come up, and it could cause, time issues and scheduling, and that creates a whole nother world of problems. Thank you. So I just scored my role play, and I got a 90, and I think that's very representative. Personally, for this performance indicator where I scored kind of low, I would say that that is very representative because I did try to wrap up the role play very fast in the last 30 seconds to cover this performance indicator that I didn't have much time to cover. And then for the other ones, I think I could have been a little more in depth prior to just jumping into the numbers with what I was actually going to be conducting. So then, it's a little more informational for the judge who's not, always a industry expert. And then in terms of creativity and communication, I also very much agree. I think I could have been, again, more clear. And then in terms of creativity, I didn't have too much, but I was also able to answer the questions in a way that the judge does at least understand the technical aspects that I'm talking about. Now, I just want to talk about the strengths and weaknesses of my role play. In terms of strengths, I think for a role play that's so technical, like accounting and also like business finance, I would say that there is less creativity needed and there is more of a grasp on financial calculations and formulas that is needed. And it's way more important for judges because this is basically the bulk of your entire role play. So I think I did have a very strong understanding for those financial calculations and the terminology and jargon that's used in the financial realm. In terms of what I struggled on, I would probably say that I wasn't able to differentiate myself with any creativity at all because I focused a lot on the technical portions rather than trying to create some sort of like creative solution for at least the ethical part where you can have a little bit of freedom of thought and response. But then, another thing that I think I struggled with was because, again, this is such a technical event, I did have to study a little bit before this role play just for the mock. And I think that one issue that I saw was with my eye contact. I was looking down a lot at my, prep and notes paper just so then I kind of know what to say during the role play. But I think for people who are watching this video and who've already made it to the states level, you guys probably have more knowledge than me in, deep finance. So I think this is something that is just applicable for my mock role play alone. And I think that you guys would not struggle with this as much. Thank you so much for watching this role play. Good luck on states and ICDC, and I hope to see you in the next video.